people are frustrated, rightfully so. And as part of that, they are, constantly looking for a crash, and they're constantly looking for, this is the end of the world, and the yield curve has been inverted longer than it's ever been. And the Fed creates bubbles and then creates busts. And the whole reason the Fed raised interest rates is because they just want to crash the market. And this is what they do. And they're in cahoots with the banks and, all these, the Blackstones of the world that are buying up all the properties are going to make everybody, debt slaves and renters for life. And I'm completely sympathetic to all of that. But I don't really think that this type of story, that the Freddie Macs doing or the GSEs getting involved in second mortgages, depending on how they structure it and depending on how they cap the CLTV, I think this is going to add a significant amount of liquidity to the market. And I don't think that's a good thing for inflation. I don't think it's a good thing for someone who's sitting there trying to buy the dip. I could see, asset markets continuing to go up. And certainly I don't know what this ultimately does to help the housing market in terms of existing homes and the tight inventory there. But
Welcome to the Rose Show podcast. Today I'm here with Jon Kutsmeda. He is the creator of Lenzen, a really awesome, first and only, fully autonomous mortgage shopping experience. He's also co-host of the MilkShakes Podcast, talking about markets and madness with Brent Johnson. And he's also an expat. So cool. We're going to be talking about all of the above and real estate. How you doing down there, down under, Jon?
That was a wonderful intro. You got it all in. I'm definitely looking forward to chatting with you. It seems like we have a lot of similar interests, similar backgrounds. So I'm sure the conversation is going to go all over the place. So I look forward to it.
Awesome. I'm excited. I love when we go all over the place. We're always going beyond the headlines and finding out what's really going on in the markets and investing. And today we're going to be focusing on your expertise, which is real estate and mortgages and rates, the housing market news. So let's begin with the big pink elephant in the room, real estate, which has a total global value, I think, over 400 trillion or something like that. I think it's the largest asset class, and we're all in some way related to it because we need shelter. So real estate, the most unaffordable market in about 40 years. It's very regional. However, we are seeing this nationally, that we have historical low inventory in many areas, including mine, the New York metro area. We have higher rates, and I'm going to say higher because it's historically not that high, but comparison to the recent past of ZIRP, they are much higher, which affects the mortgage payments and the value of property. They're trying to get their high prices. I think, what did Case Shiller said that they went up, I think, another 1.3% from February to March. And then prices are higher year over year, I think 6.5% or something like that. It's just the prices are high. We have high rates. Jon, what's going on with this market? And what do you foresee to bring it back to reality where people can actually buy homes and have it somewhat affordable?
I think it was a wonderful assessment of the overall situation. I think the year-over-year numbers printing at a 5-6% handle is really thwarting this ongoing bearish sentiment that we've seen since things really peaked out at the end of 2021 and 2022. There's endless, bearish sentiment in that market. There's so many channels and podcasts that do nothing but bang that drum. And so when you have a data set that comes out and shows that it's up 1% month to month, and 5 to 6% year over year, it really kills that narrative. And I think the reason why you're still seeing prices remaining high is mainly the supply story. And one of the things I think is important to break down in the supply story is what is existing homes and what is new construction or new inventory. Those are two very, very different elements. And the majority of real estate in the US when it comes to residential is existing homes. It's 85%. I believe that's the number of the market. And so that other 15% is coming from, your Toll Brothers and DR Hortons of the world and smaller mom and pop style developers that are producing new inventory. And so the question is that a lot of people are trying to get ahead of. And, one of the things I would preface is nobody knows the future, and anyone who tells you that they do is someone you should avoid. So all we're trying to do is keep up with things real time, build a thesis or framework about how things have worked in the past and try to apply that to some extent to the future, but it's no guarantee. And, until we see existing inventory start to improve, I don't think the stuff that's going on in new construction is necessarily concerning or helpful. And what I mean by that is I don't think some small developers, sprinkled throughout the country going bankrupt is necessarily going to kickstart a housing crisis or a crash in real estate prices. If you're in the real estate business long enough, you know that home builders, especially the small ones, always go bankrupt. It's kind of part of their resume, if you will. So I don't think, picking one or two small little projects, especially if they have any kind of, negative story around it, or if there's some fraud related, I don't think that's a string to pull on really hard. The other thing I would add too, when, the inventory is as tight as it is, and therefore, at least in the existing homes, and therefore most buyers are then led towards the newer inventory, it gives the developers a lot of power when it comes to moving that inventory. And an example I will give is, their margins, when you look at statistically, the margins that they're making on the property, it's still well above the mean. So their margins are very, very fat right now. The problem when it comes to affordability is obviously interest rates. And we can get into this, but even developers that are providing development financing, or that you can call it in-house financing, you're coming to them to get a mortgage, are still shuffling that paper through the same means everyone else in the industry does. They're going to turn around, securitize that, or sell it to a Fannie or Freddie or some other entity that's part of that mortgage-backed securitization process. And those mortgages and those mortgage rates are all determined by more or less a centralized market, how investors are buying and selling mortgage bonds. Now, what that means is on any given day, you're going to kind of have what we call a starting rate of the day, or what is referred to in the industry as par. And then anything above par is going to be a less expensive rate. And you can go high enough where eventually the market's willing to pay you a rebate to take that higher rate. The lower you go on rate, then ultimately the market needs to be incentivized, and there's fees associated with that. With lensend.com and the different things that we do, we refer to those costs as fee for rate because we want to be very, very transparent. The term points can be very ambiguous. Points can be used to refer the overall aggregate cost of doing a loan. We like to look at it specifically what you're paying the market for that exact interest rate. And the reason I'm explaining that is because developers, because of the fat margins that they have, they are able to absorb the cost of those lower rates for the customers. So a lot of home developers are still able to move inventory because they're offering really, really aggressive discounts on rates simply because they have the margins to absorb that. Where if you're going out into the existing home market, you're not going to have a mom and pop seller who's selling their primary residence to move, paying $20,000 to give a buyer an attractive interest rate. And so this is, I saw someone refer to this as the home builder sweet spot. Where interest rates are right now is so ideal for them because you have really low inventory in existing homes. So even if you're going out and shopping and you are a motivated buyer, you don't have a lot to look at. So then you start moving towards the developer side. And they're able to price things in a way that makes them plenty of profit, but they're able to incentivize the buyers with these lower interest rates because they're basically eating the cost on that loan.
Fascinating. Great analysis there. I appreciate you summing that up for us and bringing up mortgage rates, which are so important. They're a very integral part of home prices. Usually, historically, when rates go up, prices tend to come down, and vice versa. Usually when rates come down, home prices go up. But the market we're in right now, and I think let's focus on this US market of existing homes. The Fed basically has locked people in their homes. They have 2.5%, 3% interest rates. And if they sell their home and buy a new one, they're getting 6.5%, 7.5%, like the great example you gave about different ranges, like your Lens End provides people. And so they're going to be increasing their premium significantly. Plus, home prices are elevated. So their next to sell their home and move into another is very expensive. So we have that going on right now. We have low inventory, but then I'm wondering, and this is, I think, the $1,000,000 question, what can happen? Now, real estate's a very slow moving market.
Yeah.
What do you think could be a catalyst to get this market moving? Do you think that, some people say the Fed cuts rates, they can help move the real estate market. But then we think when rates come down, home price values go up. So that's not that great. And then others say rates aren't high enough because look at the real estate market. You need to have higher rates. So should the Fed raise rates? What are your thoughts regarding the rates and what could be a catalyst to get this market going?
Yeah, great question. I mean, the supply story is still the big story. I think just this morning there was a post by the White House talking about the Biden administration offering a $10,000
Yes.
tax credit or whatever it
Mhm.
might be. The problem with that is it's trying to juice demand, and the issue
Mhm.
here is supply.
Supply.
So all that's going to do is just push prices higher, even if
Mhm.
it's effective in doing that. One of the things I think is super important to point out is this situation is certainly induced by the Fed. And I think we can talk about that more when we get into Freddie Mac's second mortgage program. But they got involved in the market, in the mortgage-backed securities market, which helped suppress interest rates. And now everyone's locked in on these super low fixed rate mortgages. And like you're explaining, to move, to another market, sell and buy, you're buying at all-time highs, including these 30-year high mortgage rates. But the problem is that the Federal Reserve is very much a reactionary mechanism. And generally speaking, it's the tail wagging the dog. The market's kind of influencing the path of the Fed. And the big reason that we have high mortgage rates right now is inflation. So the Federal Reserve and the decisions they make with their overnight lending rate, the Fed funds rate, has some impact on some real estate financing products, mainly things like HELOCs. But generally, those overnight lending rates have bigger influences on credit cards, things that are more like personal loan related, auto loans. Anytime there's like an index involved, like the prime rate or the CMT, the constant maturity Treasury index. So the Fed has more influence over short-term lending. But what drives mortgage rates in the US housing market is primarily the mortgage bond market. And bond investors of all kinds hate inflation. And so the real issue that's driving mortgage rates or keeping mortgage rates high is really twofold. It's the Federal Reserve's stance or position with inflation and clearly perhaps not tackling it more aggressively or aggressively enough. Inflation does feel like it is a bit anchored, a bit sticky. Most people misunderstand that inflation is a rate of change, or at least most of the measurements that we see. So showing inflation at 4%, it's an improvement over where it was, but prices are still going up. And so the bond market is still very unsure about the inflationary outlook, partly because they think if there is some kind of pullback, the Fed is going to cut rates or come in with more QE and stimulus, which is going to further exacerbate that inflation narrative. The other factor is supply. Our government, Congress just cannot stop spending like a drunken sailor. No offense to sailors, it's just a euphemism, but that's a big issue. If you keep dumping huge amounts of bond supply on the market, it's not going to get absorbed fast enough. And the more supply there is, the price ultimately is an inverse of interest rates. So as the price of bonds drops because there's more supply being pushed on the market, interest rates are going to go up. And if you look at a chart that correlates the 30-year fixed interest rate with 10-year Treasury bonds, they basically mirror each other. And that's very much been the case for a long time. Now, right now, we have spreads much wider than usual. They're well over 220 basis points when you compare the 10-year and the mortgage bond rates. So that spread needs to tighten, number one. But overall, in order for bond rates to come down organically, I think inflation needs to be less of a concern, and I'm not sure when that's going to happen. And supply needs to be much more constrained, and it doesn't look like the U.S. government's going to stop spending.
Agree. Well said. It's always about supply and demand, and I agree. I think that the massive fiscal spending will continue, and there's no end in sight. We're over 34 trillion in public debt, as well as over 1 trillion now in interest expense. And it's bloating the GDP. If you remove the government spending from the GDP, I think you can see that the private sector is in severe hardship. And then you look at GDI, which is greater than GDP, significantly greater, which just shows a very stagnant economy that we have. But the fiscal and monetary policies need to be in alignment, and they certainly are not. They're just spending to no end. I like how you said, like a drunken sailor. But yeah, and that is definitely inflationary, fuels inflation, and it leads to monetary destruction. And if you look at Fred's chart on declining purchasing power, it's like a cascade going down since the 1950s. I'm surprised they still have that chart online. They took down the M3, but they still have that chart for now. But the Fed exacerbates the economic cycles, in my opinion, and they definitely did their number on the real estate market, which is very much related to, like you said, they control the short end, they don't control the long end, and mortgage rate has to do with the bond market. Very important concept, and I'd like you to explain to our audience, because you are an expert in this, and it's important that everyone knows and understands this, because we're all involved in some way at some point in our lives with mortgages or some type of shelter. So we need to understand this. So in the beginning of 2022, something happened. I believe you talked about this on your show, on a great podcast you have, Jon. Could you tell us what happened that caused the prices to fall and the rates to go up before the Fed even was able to raise the federal funds rate?
Yeah, I think it goes back even a little further than that. I think one of the things that people are very unaware of is what was going on behind the scenes, and not some like super cloaked in mystery behind the scenes, but behind the scenes in the context of that most people weren't paying attention. And that is at the end of March, when markets, really fell off a cliff. Everyone's familiar now with the V-shaped recovery. But before that happened, you had Treasury bonds, which are the most liquid investment. They're basically the risk-free asset. And the reason they're considered risk-free is because in any certain market situation, you should be able to use that as pristine collateral, whether it's to liquidate and raise capital or to pledge for other reasons, should there be something like a margin call. And treasuries were almost trading like penny stocks. There was a severe lack of liquidity. And that ultimately trickled over into mortgage bonds. I mean, if you have the most pristine collateral not trading, well, then the mortgage bond market, is going to completely seize up as well. And that's what happened. The other factor that influenced this complete catastrophe in the mortgage bond market was you had Congress moving ahead of the market, so to speak, in terms of making these forbearance decisions. And so they basically gave everybody a mortgage holiday. The problem is that you have, in the mortgage world, you have a lot of these non-bank lenders and even banks that are going to fund these loans, and then they're going to turn around and sell them. And a lot of people will refer to the company or entity or lender that they're making their payment to as the company that owns my mortgage, or that's my lender. In reality, that's just your mortgage servicer. They're collecting a spread above what they're paying the bond market. And so it's a very lucrative business, but they're not really, their capital isn't on the hook. The bond market is basically taking them out when they're buying into or funding into these securities. And so these servicers are really just there to collect the spread. Number one, there's something I'll add to that is they could care less whether your interest rate's a 7% or a 2%. The way the industry is structured, they're going to package your loan into certain tranches. And for the most part, no matter what your rate is, they're going to make 0.25 up to 0.75 spread on that servicing portfolio. So it's a very, very lucrative, in general, low risk business until you start to have mass defaults, or at least in this case, global or national forbearance, because the servicers are still on the hook to make a payment to the bondholders, whether they're collecting payment from the borrowers or not. And so that was another element that created a huge, basically, market freeze in the mortgage-backed securities market, because that liquidity engine was so suddenly dead, because no one wanted to go out and buy more loans when there's no payment going to be coming in, and they had no recourse to take because the government said, hey, forbearance for everybody, and you can't go after these people. So that created a really huge crisis. A very similar like seizing up of the machine is how we had the GFC in 2009, where suddenly all these loans were going into default, and that liquidity was no longer coming in to do the rinse and repeat of funding new loans, selling them, funding new loans, selling them. So we had a very, very similar situation that brought down, or almost brought down the global economy in 2009 happened behind the scenes in 2020 at the end of March. The Fed, of course, came in, bazookas blazing, and injected trillions into the economy, specifically in the bond markets. And they were buying both treasury bonds and mortgage-backed securities. Then behind the scenes, there was deals worked out to add liquidities to all these servicers so they didn't go bust. And slowly but surely, confidence was restored and liquidity was restored to those markets. And you went from a market where you could not get a loan done to suddenly, a month later, really more or less 2 months later, to all-time record low interest rates. You were talking, 30-year fixed mortgages in the low 3% where the borrower wasn't paying much at all for the rate. And if you were doing more of a government loan, like an FHA or VA loan, you were getting something in the twos. A lot of people don't realize the dynamic that drove that, which was the government coming in, or at least the Federal Reserve coming in, because the government was more on the stimmy side, right? They were sending checks out to people, where the Fed was juicing the bond market, which ultimately brought down interest rates. And that's how you had this huge burst of activity in the housing market. At the same time, we were having the same or very similar supply dynamics that we're having right now. Now, one of the reasons I start there is because right now I do see a lot of, I guess you can say, like, chest pounding and people talking about how great their situation is. And I got this 2% rate, or I got this 3% rate, especially when it comes to the discussions around second mortgages. And it's interesting to me because everyone wants to scold the Fed and criticize the casino and make all these comparisons about the market and people who are taking risks or going out and buying homes at, in 2022, and you're so foolish, you're buying at the top, when no one would be in the market right now. None of these people who have equity would have equity or have a home if the Fed didn't jump in 2009 and bail out the markets, and again do it in 2020. So I am not a fan of the Federal Reserve. I'm certainly not a fan of their strong-armed and strong-handed impact that they have on the market. I'm just giving some context where everyone wants to pound the table and say, the Fed is awful, while at the same time ignoring the fact how much they have benefited and still continue to benefit because of their involvement in the capital markets.
Yes, absolutely. Well, they did their job, and that was the point of the Fed, was to help, add liquidity and to help the markets and prevent banks from collapsing, which, the banking crisis that we had was a symptom of all that, ZERP policy and all that free money that we had. And inflation is also a symptom and a result of that. I like to quote Milton Friedman: inflation is always and everywhere a monetary phenomenon, and they significantly increased the money supply in trillions. I hate to always use the number of 4 or 5 plus trillion, probably more. And that's what caused this massive inflation, which is entrenched. Like you said earlier, it's still increasing month over month. I believe it's 0.3% month over month CPI. And to me, that's in how they calculate it. And I think it underestimates the true inflation, which, if you look at the shadow alternative inflation, is more than double the CPI print. It's probably like, high five, like 6.5, something like that. And, it's in the way they change the calculation of how they calculate the CPI. But that's a whole other story. But, we all know they're higher prices. I mean, I don't have to look at a CPI print to know that prices are elevated and they're not coming down. So that's just where we're at right now. So, I want to talk about liquidity and this Freddie Mac. It was a great podcast you did, and it's important that everyone understand, like you said, a lot of people aren't paying attention. So it's important that we know what's going on and know what the ramifications and the effects are. So there's this rumor now that, well, maybe it's true. Freddie Mac is looking for approval to do second mortgages. They're proposing purchases of the single family close-end second mortgage, is the exact term from the headlines. So this will provide liquidity, I believe 32 trillion that people can take out of their homes. And I believe this will give them access to taking equity out at a much lower rate. Jon, please tell us what the effects are of this Freddie Mac.
Well, first, I want to reference something you just said. The inflation is still an issue. And one of the things that's an interesting dynamic is that interest rates, or higher interest rates, are actually inflationary To some extent, until they're not, until, the debt burden becomes too much. But one of the reasons we're probably still seeing these consistent inflation prints is that anyone who has savings is now getting paid 5% to park their money with the government. And
Mhm.
so that liquidity starts to flow back through the system. So, it's again a bit of a government handout when you think about it, but that's one of the factors that I think is adding to some extent the health of the economy. I know it's a very personal story. A lot of people will say you have no idea how hard it is, and I empathize with that. But you can look at in aggregate, there is definitely a divide between the haves and have-nots, and as long as you have something, you're getting paid a pretty healthy interest rate. And I think that adds to the frustration when, those who have are gaining the benefits, those who don't are frustrated because they can't get
Mhm.
into the market, they can't buy assets, everything's inflated. And, this is somewhat true in the case of what Freddie Mac is considering, but again, it's one of those things where if you don't take risk and you don't enter into the housing market at these various times when you could have, then you're certainly not going to participate in a lending program. But I don't think this second mortgage program is necessarily or shouldn't be labeled as something that's there to, make the rich richer. I think, for a lot of people, the biggest investment they make is their home. And they have benefited by the fact that it's at least kept up with inflation. I think the Bank of International Settlements released data recently that showed globally housing is since 2010 up 23% versus inflation. And I would argue and say that that's probably because they have inflation wrong. And historically, if you look at the data, there's a great index called the Herrengracht index, which looks at this area in the Netherlands, which has always been in the Amsterdam area, which has always been very, very sought after and valuable. And so the data set goes back over 500 some years. And you can see that over time, based on inflation, real estate generally only kind of keeps up with the rate of inflation. So if the BIS is telling that globally housing prices are up 23% versus inflation, I would say that number one, housing prices therefore are likely to come down, or they're completely underestimating the inflation. And I definitely think it's the latter piece. But back to the Freddie Mac story. This again is a result of the strong-handedness of the Federal Reserve coming in 2020, providing massive liquidity to the bond market, pushing interest rates down. And now you have a huge mobility issue for all the reasons we've talked about here and that you mentioned, which is no one wants to give up that 3% interest rate, buy a house at all-time highs with 40-year high mortgage rates. And so there's a lot of that mobility is trapped and a lot of that equity is trapped. And so you can go out now and go into the private market and attempt to get a second mortgage. One of the most popular options are HELOCs, which stands for Home Equity Line of Credit. It's an open-ended form of credit, just like a credit card. You can create the line of credit with a bank or a lender, draw on it when you want it, pay it back, and then redraw on it in the future as you grow that balance back as you pay down the debt. Those loans are generally tied to an index, something we talked about earlier, and those indexes are variable, and those indexes also tend to follow the monetary policy of the Fed. So there was a sweet spot right around February 2022 to, leading into the summer, we'll call it June, July, where the bond market had already sniffed out the fact that inflation wasn't going to be transitory, that the Fed had gotten this wrong, and that, there was an inflation problem. Like I mentioned before, bond markets hate inflation. So they started selling bonds very aggressively long before the Fed took any action, and certainly before they admitted a problem. So interest rates on mortgages were already trending up, well, pretty steeply going into March when the Fed did their first hike at 0.25%. And they continued to trend up high aggressively before the Fed really took things seriously when we had a 9% CPI inflation print in July of 2022. And that was when the Fed did their first three-quarter rate hike. So before the Fed raised the short-term lending rate, you could go out and get a loan like a HELOC at a very attractive interest rate. And so a lot of people did do that. The problem is now we're 2 years from that. A lot of HELOCs have these teaser rates. So they'll be fixed for a year or two. then they'll start to adjust, and they're going to adjust based on short-term lending rates. So a lot of those HELOCs that might have been 2% teaser rates are very quickly blowing out to 8 to 10%. So that's an issue. And anyone who wants to go into the market now and get a HELOC, number one, because of the liquidity issue for banks, I don't want to, have people drinking too much from the fire hose here, but banks hold assets like treasuries, partly because they're required to, but also for the same reasons I talked about before. It's pristine collateral. It gives them the ability to do what they need to do in secondary markets, sell, liquidate, raise capital. But when you have assets that you bought back in 2020, 2021, when those interest rates on those bonds were 0.5% or sub 1%, and now you're looking at a 10-year treasury bond yielding, 4.5 to 5%, the value of the bond that they bought in 2021 has dropped significantly. And this creates a big issue for bank balance sheets. So they're very nervous about going out and lending because they don't really have the collateral should some of those loans go bad. And so that creates an issue not only for someone who's going out there and trying to get a loan like a HELOC, which is generally a bank loan, but it also creates an issue because of the other dynamic I mentioned, and that is short-term lending rates are much higher. So the indexes that the banks are going to use to calculate the interest or the risk that they're willing to take is also much higher. Now, you take what we call a closed-end loan, or I sometimes refer to as a fully amortized term loan. It gets even more expensive because now whoever does that loan is doing it for a fixed amortized payment. So there's going to be principal and interest, and generally a much longer period. It can be 20 to 30 years. So that investor is taking a subordinate position, meaning they have to sit behind the first mortgage. So they have greater risk. And at the same time, they're locking up their capital at a specific interest rate for a long period of time when there is market uncertainty. What are home values going to do? What is the Fed going to do? Is inflation anchored or only going higher? So there's not a very attractive option when it comes to second lien mortgages. And so for people who want to tap into their equity, it's been a very constrained or restrained opportunity or set of options for homeowners. And the big thing that I think people are underestimating is the amount of personal debt people have absorbed over the last 2 years that has also gone up significantly because of what short-term interest rates have done. So credit cards are 30%. Car loans are, who knows what those are now, but the lifestyle that people have become accustomed to is often financed with these other types of personal credit, and it's become very expensive. And a lot of people become used to rolling that debt into their home equity and giving themselves that payment relief. Now, I'm not justifying that or saying that's a good thing, but that is the circumstance that we're in. And so for a government-sponsored enterprise like Freddie Mac to come out and say, hey, we're thinking about doing second mortgages, I think overall can help the market. Number one, I think it'll stabilize a lot of people's financial situations. And if you didn't have this interest rate environment, this is how what we're talking about here is all interconnected. If the Fed didn't get involved the way that they did, assuming that the world didn't implode and it rebalanced on its own, we probably would be somewhere around this 5 to 7% range anyways. And so most people would be sitting on a 30-year fixed mortgage at an interest rate where they wouldn't really care that much about refinancing it because they would be giving up maybe 0.5% or a full percent of interest. That's not something people would hold on to so dearly. And so I think you would be seeing people going out and doing cash out refinances to consolidate debt and to bring down their monthly expense ratios. They're just not able to do that, at least emotionally right now, because they don't want to give up that 2.5%, 3% mortgage. And so they're looking around trying to find another option. If Freddie Mac enters the second mortgage rate or second mortgage loan environment and does so at an attractive interest rate, nobody knows what that's going to be, but let's say it's sub 10%. I think it's going to do a lot of good for the marketplace because number one, people at that point can now go out and get a loan and consolidate some of these high interest rate debts that they couldn't before. And I think that will do a lot to, support and stabilize some of the overall economic picture for a lot of people. And on the other side of that, I think, the existing home market, I don't know if the Freddie Mac second mortgages are going to do much for supply. I think that's a whole other story, but I do think it will help with mobility. And so there could be a decent exchange of properties in certain markets for someone who wants to move doesn't want to necessarily give up a home that they've been in for 12 years that has a 2% interest rate just to tap into that equity. So I think you will see that, people are now going to be able to rent out that property, which should, add supply to the rental market, which will help a lot of people, while being able to use that equity to relocate and shift kind of the inventories around and be able to put a down payment on a new home. And at that point, they're comfortable doing a 6.5% or 7% mortgage rate because they're not taking, a giant mortgage. They're putting 50% down instead of 5 or 10.
Thanks for explaining that. Now, when I hear you talk about this, it's in my mind, I think, we know credit card debt is high. It's at an all-time, it's so high for consumer debt right now. And so we have higher rates, credit, the Fed fund rate is what affects the credit card rates, and that's the short term. So we have credit card rates are extremely high. So this will help provide that liquidity at lower rates. They consolidate that debt with the HELOC, which is normally what you do. You usually get a second equity, you get a second mortgage on your home, your HELOC, and then you consolidate all this short-term debt that's at a higher rate. So it'll help people. But when I think of it's a money merry-go-round. It's like, it's just going to keep the music playing, and it's great. It's going to help people. And that's important. It's going to help, like you said before, the haves. Inflation helps the haves, not the have-nots. And, being a homeowner, you're going to be able to do this. I don't think it's necessarily going to get the real estate market going and people buying and selling more. Maybe it will help with providing liquidity. Maybe they can put a down payment on a rental, a vacation home or something, and they can use it for something, or they can help float that second or third home that they currently have that's not cash flowing right now. So instead of having to put that on the market, maybe they can hold on to it. Who knows, whatever they use it for. But it's to me, it sounds like a sort of like a bailout for people like homeowners. And do you think that this can keep prices elevated or maybe even drive up home prices?
Yeah, so a couple of things there. The one point I'll make on my previous comment too is that I think this is not changing the risk to Freddie Mac or the housing market. Some of the people who are against this think it's some sort of like hook to trap homeowners in some sort of risky second mortgage, and it's all this big scam. And I think the real point I was trying to make a moment ago is I think that part or that narrative is silly, because this is something that homeowners have been doing consistently for the last 2 decades, but normally just refinancing their first mortgage, pulling in that other debt as a cash out or debt consolidation refinance. And so the same risk that a Freddie Mac or a lender that would be taking doing that type of loan, the composition is the only thing that's really changing here. So instead of having, let's say someone has a $500,000 mortgage, they're going to consolidate 50 grand of debt. Normally they would probably refinance both of those into one loan, and they would have a new interest rate on that one loan at 550,000. Well, in this case, they don't change the $500,000 mortgage. They go and get a second for the 50,000. So the risk or the loan to value ratio combining both of those loans, what we call CLTV, is the same. It's the, whatever the value is on the 551st is the same ratio that you're going to have when you combine those two at 550. The second mortgage obviously is going to have a slightly higher interest rate, so it's not as attractive given situations in the past where you can combine both into a lower interest rate. But I do think this is going to I think the reason why this is important is in the broader economic story or the broader economic narrative, where I think people are frustrated, rightfully so. And as part of that, they are, constantly looking for a crash, and they're constantly looking for, this is the end of the world, and the yield curve has been inverted longer than it's ever been. And the Fed creates bubbles and then creates busts. And the whole reason the Fed raised interest rates is because they just want to crash the market. And this is what they do. And they're in cahoots with the banks and, all these, the Blackstones of the world that are buying up all the properties are going to make everybody, debt slaves and renters for life. And I'm completely sympathetic to all that. But I don't really think that this type of story, that the Freddie Macs doing or the GSEs getting involved in second mortgages, depending on how they structure it and depending on how they cap the CLTV, I think this is going to add a significant amount of liquidity to the market. And I don't think that's a good thing for inflation. I don't think it's a good thing for someone who's sitting there trying to buy the dip. I could see, asset markets continuing to go up. And certainly I don't know what this ultimately does to help the housing market in terms of existing homes and the tight inventory there. But I do think it will create some mobility. And overall, I think, the system is a debt-based system. And, people get really upset again about all these things related to the mortgage world and the government debt. And, again, very sympathetic to these things. Something Brent and I talk about all the time on the Milkshakes Markets Madness show is that, there's a difference between how you want things to work and how things actually work. And it's a debt-based world. And if the government doesn't keep issuing debt, and if we as consumers don't keep taking on debt, the system will collapse on itself. There is not enough money in the system to pay all the obligations. And that's an unfortunate truth. And I wish everyone to be debt-free. I really do, because there's a lot of freedom in that. But if everybody truly was debt-free, the system would implode and it would be a very, very scary situation. So I'm not a fan of the direction that I see things going, but there's a difference between liking reality and accepting reality. And I think the first step is to accept how this is potentially going to play out. I agree that most likely this is somewhat being treated as a bailout for certain people who are, number one, stressed because of the high monthly expenses that they have. But this is also a bailout to a very powerful industry, the banking industry, because remember, this is an industry that has become concentrated. This is why we built LensEnd.com. Mortgage rates and the entire mortgage world passes through one of two entities for the most part, Freddie Mac or Fannie Mae. Government loans get securitized into Ginnie Mae securities, but it's still the same machine. It's a sausage making process. And that business, for the most part, is driven by volume and the fees that you collect on originating new loans and originating new volume. And that has completely dried up. New purchase mortgages is at a 30-year low. Refinance mortgages has been at a decades low for the last 2 years. And so, yeah, Freddie Mac is getting hurt. The banks and non-bank lenders that are in this industry are getting hurt because they're very bloated in size and they're used to doing very high volumes and collecting high fees, and all that has collapsed. And so all the things and all the stuff that people talk about as to what's potentially motivating this doesn't make it not true that as to why it's potentially going to go through. And you have to start thinking about what those knock-on effects are instead of getting all emotional about how unfair it is, which I do emphasize with.
Very well said. I mean, it's about what it is, the reality of it. And our system is based on debt. Over 80% of the money growth is from lending. And then I think most people think it's the Fed's printing, it's the printing press, right? Well, it's, the money is created from lending. And when the Fed raises interest rates, they slow down, they reduce the supply and demand of the loans and the lending. So we've been going through that lately. And so it's important that we add that liquidity. And I can see the benefit of this. I think it's very important. They're very smart people. People like to say they're inept and all that. And, they're very smart people and they know what they're doing. And this will definitely help the people. And that's what's most important here. And it is a debt system. And we just need to accept that. There's so much to talk about with debt and there's so much to talk about with inflation. And I do believe all these tools lead to higher inflation. And I think we could be in for a stagflationary environment, unfortunately, and that's the reality of it. But are you concerned about the debt now? And I'm gonna just explain my question. There are people on one side saying that it's the end here. There's too much debt. We're insolvent. And it's all over. And at some point, it's just going to implode. They're going to take the printing press away and it's going to implode. Then there's the other side that says we can kick the can down the road much further than people think. And the US can just, print its way out of debt and we're the global reserve currency. So we have nothing to worry about. Those are two extremes there. But are you concerned about the US debt? And China and Japan, I think, is selling US securities and they're going into gold. That's all making the news as well. What are your thoughts?
It's a really fun topic, and fun might be the wrong way of putting it. It's a very, it's a very controversial yet stimulating discussion because there's, I think, again, going back to this, the way you want to see things versus how they really are. One of the reasons that you're seeing China do some of the things that it's doing, and this is again one of these milkshakes pod topics that we go over at nauseum, but is because of the stress that they have in their own economy, and to defend their currency from getting weaker because they have a soft peg against the dollar. They have to sell certain types of assets. And at the same time, they also have to accumulate other types of assets to stabilize, where they sit in the global economy, especially when it comes to trusting, the strength of their currency. So I do think they're, accumulating gold for other reasons, geopolitical reasons. But one of the things that, I think it's misconstrued is what they're doing with U.S. Treasuries, or the amount that they're selling U.S. Treasuries. A lot of the data that you're seeing is not the size of, or the number of treasuries that they hold, but the actual net asset value. And so it is true that they have sold some treasuries, but most of that is defending their currency from what we can see in the data. And the net asset value decline, it's not that China's selling this massive amount of treasuries. It's that the treasuries they bought were many, many years ago at much higher prices. And because bonds have fallen so much in price, it's basically like they got a tax on their reserves. And so the amount of, capital that they have to defend their currency has declined significantly because the bonds that they hold aren't worth as much. Overall, the argument about debt, I think it's an important one to watch and consider and discuss. It's certainly, a unsustainable thing at some point. I agree with that, but inevitable is not the same as imminent. And the situation in Japan, I think, is the best example. I mean, they've been at ZERP, more or less doing yield curve control, going into the bond market to control interest rates for the past, it used to be called the lost decade after the 80s. Then it became, 2 decades. And now here we are pretty much 40 years into this monetary experiment that Japan has continued to pull off, where, they're entering the market and they're, directly monetizing these bonds to keep interest rates low. And although the currency has certainly been under pressure, over the last 2 years, it going from, 120 to 160 is something to watch, but it's still relatively within the range. And it's certainly nowhere near its all-time highs back, prior to the Plaza Accord. So I think the main point I would say is I think the conclusion that, the gold bugs have and the Bitcoin maxis have and all these people who are hard money advocates have is accurate. It's just the timing that they potentially have very, very wrong. And there's without naming names, there's been people who've been calling for the end of the US and the end of the hegemony for 20 years. And the first paper a lot of people reference, or first article, was back in the 70s. And so I think it can go on much longer than people expect.
I agree with you. I had this great international relations scholar on here a few months ago, and he said the similar things. He said that hegemony is not over, and he thinks it's, he says China is just a geoeconomic competitor, and he still thinks the U.S. is the leader and will remain that way. And his concern about debt was it'll keep going on. It's unsustainable, but it will go on much longer than any of us can imagine. So I don't think it's something for us to worry about in the next 30 months or so, in the short midterm or anytime soon. But it is a concern overall, absolutely. Now, inflation. We know that this debt and all this spending further fuels inflation. Do you believe we're in for a really inflationary period, let's say in the next few years, maybe the next 5 years?
That's one of those, predicting the market type of questions that I think is really, really hard to do. I think the question I have the most is, will government spending be, at least to some extent, minimized? And it doesn't really seem like that's the case. Now, at some point or another, is there some sort of economic catastrophe? And is that reactionary muscle still so ingrained in capital markets? When that happens, is the flight to safety still US bonds? And in that environment, is it something that ends up pushing yields back down to closer to the mean on this long 40-year downtrend that we've had in interest rates? or does it push us back close to where we were at record lows in 2020? That's the question mark, is how does the market respond in a crisis when it comes to treating bonds as the safe haven? And will we, eventually put in a double bottom, or go back to some sort of low trend line that we had before? I think situationally, that's something that no one really knows how the market's going to respond. But outside of that, it does feel like, both from a standpoint of demographics and a number of other things, that interest rates could continue higher. At least maybe we're in a new normal and we just kind of trend sideways, where the treasury markets in the fours and the fives, mortgage rates are in the 5 to 7 range. And this is kind of where we stand. Economically, can we grow our way out of that? The goal always is to inflate ourselves out of the debt. So I don't think the Fed or anyone behind the scenes has any intention of really bringing inflation down or controlling it. They silently kind of, or they don't directly say it, but I think they would love to have something more like a 3% inflation target than a 2% inflation target. But things like artificial intelligence, and there's a lot of other innovations that are going on that I think can could continue to help economic growth scale from here, despite the heavy debt load. But it does become a burden at some point. And I think the bigger issue is the unfunded liabilities and contingent liabilities, such as Social Security, Medicare, all those types of things. But if we manage to get through the next 20 years, and God bless all of them, the baby boomers aren't with us anymore, a lot of that debt burden is gone. And does that create a more sustainable debt environment, or does it skyrocket inflation because we now no longer have this huge debt obligation that we have to pay? Those are questions that we have to certainly keep in mind over the next decade.
Absolutely, $1,000,000 or $1,000,000,000 questions at this point. But there's something that we have to definitely think about. And yeah, the inflating away the debt, that's definitely an ongoing issue. And I want to go into another asset class, equities, a big one right there, the market, the stock market. And, being a contrarian, we see that there's so much bullishness in the air, and then, we like to be more bearish. And then when we see too much bearishness, we like to be more bullish. But this AI story, I have to say, I think, we know technology is deflationary, and it is a big deal. And some people are saying it's like a revolution. It's like an industrial revolution all over again. And we have NVIDIA at the center right there with the large moat. And of course, one stock shouldn't hold up the whole market. And I believe you did a show on that, which is a great point there. What are your thoughts on this AI and equities? And what are you bullish on, if anything, in the equities market?
Well, I think the thing that I've thought about recently is, what I find kind of funny is, a lot of the people who've been in the capital markets say the last 30 years or more. I feel like in a lot of ways have become what they probably told themselves they never would become, kind of this like cynical, crotchety old, like, I've been in the game for so long and this is how things work. And there's definitely this intense pessimism. And anytime something comes out, or a new idea comes out, or there's this new emotional momentum behind something, they immediately, trash it as, the next bubble, or it's all fraud, or we've had this thing, there's nothing new under the sun type of comment. And I get that. I think there's a lot of truth in that. I think what we experienced in the cryptocurrency market, for the most part, the last 4 or 5 years, I think supports that point of view, because a lot of it is just vaporware, a lot of pump and dump, a lot of just, it's another place for people to gamble in a lot of cases. Now, what I think AI is very, very different. I do think, the PE ratios and the price of some of these stocks like Nvidia might have, reached an extreme in the short term. But anyone who actually goes and digs in and plays with these tools, and really gets involved with what's going on in the AI world, for anyone to say that this isn't a pivotal moment and things aren't changing very quickly, I think they're blind to what's happening, and their bias is causing that blindness. Now, one of the things that's really interesting about NVIDIA, and there's a lot of, not a lot, but I have seen some people trying to do some research or investigation to call out how there might be some, money washing, and there's various other things going on, where some of the actual revenue or growth that NVIDIA is experiencing isn't necessarily all true. I don't know enough on that to comment. I do see people starting to try to poke holes in that. But what I will say is NVIDIA continues to beat earnings estimates and then guide higher. So I think this is very different than just a bunch of hype around something that has not shown up to support the numbers. Every quarter when they're reporting, they're beating estimates and then guiding higher. So, has the market gotten ahead of that? I think we thought the market got ahead of that 3 quarters ago. And every time NVIDIA, beats estimates. So I think AI is a big deal. I think, if I were someone who is looking to do more of like a top-down approach and make some long-term bets on artificial intelligence, and this is not investment advice, but I would start looking around the data centers, the where people are going to be getting the energy for this, and the place to process this type of artificial intelligence. Those are I think knock-on effects of this. That do you buy NVIDIA at $1,100, or do you get into subsectors that are going to benefit from this AI boom? Certain energy sectors. Do we start shifting more towards nuclear because of the cost? I mean, these are definitely things I think are worth investigating. But I don't think AI is a fad, and I don't think we've even seen the tip of the iceberg.
Agree. I like that. Infrastructure and data centers, I'm very bullish on myself. And that's all. I guess some people call it the picks and shovels or whatever of AI. I think there's so much more. I think AI is a huge just a revolution, a whole new way we live and work. And it's amazing what it does. It's like nothing ever before. So, and we don't need to focus on one. I mean, the video is fantastic, but there's so many out there, and you said it so well, Jon. Like VRT, VST, I mean, CEG. I mean, I could just go on. There's a whole list. There's like a big list of them, but nuclear, and that's another important issue. This uranium has been a big bull market, and it's been running. Some people say it's in a bubble. Others say it's just beginning. And then they say it's about the supply. I mean, I've spoken with energy people on this, and I'm bullish on uranium and nuclear. But I think we can go into commodities, because that's what this is, energy. So we go into energy, oil, nuclear. What are your thoughts on commodities? And of course, gold, which is more money than it is a commodity. People always make that distinction. And then the other metals, copper, which is also an essential part of AI and everything, semis and everything, and silver.
Well, there's definitely more. There's definitely people who are more experts on this than I am, but in terms of something that is very core to, say, like Brent Johnson's dollar milkshake theory, I mean, it's something we talk about extensively. What I will say when it comes to commodities, especially those that are critical to national security, specifically in the energy sector, but even some of these metals like silver and copper, I think one of the things that people need to think about when they're trying to make investment decisions, or at least predicting, the future trajectory of prices, is that don't underestimate the U.S. government's ability to go in and manipulate these markets, and to do things that are in the best interest of them and in the best interest of national security. But I think for the most part, markets across the board have kind of run a little hot. I think there is this natural aspect of markets to move on expectations. And for very, very long, a lot of the price action has been based on the expectations of what the Fed is going to do when we do get ourselves in some sort of crisis. So perhaps, I'm not saying this is true, but it's something to consider. Perhaps those moves are already fully priced in. And so if we are in a situation where the Fed does have to respond or react, are those asset classes going to sell off? Because number one, they now also work as collateral. Generally, the baby goes out with the bathwater when you have a crisis. Although gold is something that you want to own as a hedge in those environments, it ends up falling in price because it's doing exactly what it's supposed to be doing, which is acting as collateral or something that you can liquidate to raise funds when you need to. So a lot of these hard assets, I think, when you look at it from an industrial perspective, I think the argument for why, there is more room to go in price is understood. But at the same time, if you're looking at them from an investment portfolio or a hedge perspective, I could see where if we go into a crisis that, a lot of these assets sell off and could sell off pretty hard, not because they're not of value, but because they are of value and people are, selling them to support other aspects of their business or their portfolio.
Yes, liquidity, when people need liquidity, they need cash and they need money, they're going to be selling those real assets. And, inflation also affects the bottom line as well as the top numbers. We have higher prices. So it's not necessarily when we see, the market, they say are inflated, right? Well, it's inflation raises prices and it raises the asset prices as well. So that's another thing that very important to take into account. And inflation is unfortunately here to stay for at least a little while longer. So, and gold is, like you said, an excellent inflation hedge, and it's a real asset. Now, AI and Lenzen, I think those have something in common there. And you utilized autonomous AI to work with lending. Tell us about that, Jon.
Yeah, this is something I'm very, very proud of. I think, spending 20 years in an industry that I wasn't necessarily in love with. I think a lot of people end up in the real estate world because it's a lucrative business. It's a lucrative profession. And at a young age, it's kind of how I got involved. And I was front row and center. I was 2005 is when I got in the business. I was originally with a subprime lender, and so when that whole world was imploding, and I was watching some of those things go on, and it very much was a like front row watching The Big Short, seeing how these companies were getting bailed out, and kind of scratching my head around, what was really going on. It was a very enlightening time for me, and ever since then, I've kind of had a bad taste in my mouth about how much profiteering and profit seeking goes on in these businesses with so little value add. And, the National Association of Realtors are, about to change, I think, significantly with this potential ruling on the settlement. Maybe come July, buyers agents are something that slowly goes out the door. They've settled a $400 million settlement. I think things like that happen because people have gotten too far away from serving the customer and focusing on that user experience and become too focused on what's good for themselves. And I've experienced that through, 10, 15 years in this business. We've always wanted to find a way that could scale. The clients that we serve, we give them this deep analysis. We give them this consultation. We explain how all mortgages get bundled and sold into these mortgage-backed securities, and all interest rates are universal. It doesn't matter what bank or lender you go to. No one's giving you your options because they know you or like you or trust you or you have a checking account with them. It's just not how it works. All interest rates basically come from the same place, and the people you're dealing with are simply slapping a margin on top. And, there's a lot of education that goes in to enlightening people to that reality. And it just doesn't scale if you're just trying to be on the phone, teaching somebody about that reality, and then trying to walk them through the numbers. And so it's always been at the core of who we were, is the identity of us as a company. But it was just unscalable. I mean, meaning to grow the business, we would have to hire immense amount of staff. And even that doesn't scale, because when you bring a lot of salespeople on, they want to make a commission, and all that stacks on top of the margin. And then before long, you start to kind of, lose your values, and you're no longer in the business serving the customer and giving them a really great deal. You're just another entity out there that's stacking a ton of margin on top of an interest rate, when all you're really doing is kind of walking them through some paperwork. Now, there's definitely important aspects to the consultation as far as what rate you should choose. Talking about, high rate provides these rebates, low rate comes with cost. Because of that, depending on someone's timeline, low rate is not always the best option. If you can get an interest rate that's less expensive, that's going to give you some runway before the lower rate catches up. Another way of looking at it is, if you spend, say, $10,000 for a mortgage, a certain mortgage rate, and maybe that saves you $200 compared to another, well, you're not going to actually break even when you look at that comparison until 50 months. You've got to put that $10,000 cost that you spent back in your pocket, something we call break even or recuperation. So those are things that take a lot of time to discuss and go over with people. That again, like I said, just made our mission for the industry very hard to scale until we, were able to build LensN, integrating a little bit of our artificial intelligence with some algorithms. And now people can go through, number one, they can look at real-time mortgage rates. So the same type of technology that any bank, broker, loan originator is going to use to price a loan for somebody at any given moment, we've now democratized that. One of the ways I look at it is we've done for interest rates what the Zillows and Redfins have done for the real estate inventory. Before, you didn't know what homes were for sale unless you went to a real estate agent because they had access to the MLS data. Websites like Zillow now made that public where anybody can go online, see a property's history, and really do their own research. We've done the same democratization with mortgage rates. Before, for you to get an accurate interest rate, you'd have to, go through someone in the lending business. Every time you did that, it felt like a push or sales pitch. And even then, there wasn't a whole lot of transparency as to what you were really getting or why you were getting that type of interest rate. So we pulled the curtain back on that. You can see real-time interest rates, and we don't collect any information. So there's no logins necessary. You don't give us any personal data. We've made it all front and center so people can, for their own sake, stay educated and stay informed on what interest rates are daily. Now, if you want to go a little bit further and kind of customize a situation for yourself and get some of that analytics and that analysis that would normally be hours of consultation, we've automated all that. So you can go through the whole journey, pick an interest rate, and then use the very, very, in my opinion, they're very fun to use, very intuitive visual tools that tell you what interest rate to choose based on your timeline, based on hard mathematics. There's no subjectivity here. And that's the thing that I think people make a mistake about, is that picking an interest rate has some sort of subjective element to it. And it really doesn't. It's just about the math. And we've solved all that. We've created an environment that does now scale. We have as many people as there are home buyers go through that whole process and choose the loan that makes the most sense for them. And it's purely objective based on the numbers. The only thing that's subjective when somebody is going and shopping for a loan is their timeline, either how long they think they're going to be in that loan or how long they think they're going to be in that home. And the loan part is where, I think there is some really interesting macro conversations to have. Everything that we've been talking about here is, what's the bond market going to do? What are the Federal Reserve going to do? Where are interest rates going to be in the next 24, 36, or 50 months, right? That timeline is the only variable that someone needs to consider when making a loan decision. And we give all that information up front. We do all that analysis in mere seconds. So we've compressed what normally is this very painful experience for consumers where they can't get interest rates without filling out a form and getting on a sales call, and it's all awkward and it just doesn't feel right. Ultimately, with an entity that is trying to make way more money than, in our opinion, they deserve, which massively jacks up the price on these because their margins are so fat. So we've eliminated all that, made it very seamless, give everyone the information they need to make a decision. And like I said, it's all up there. There's no contact information we're collecting. So you can shop us all day long until you feel confident that the information we're giving you is not only competitive, but accurate. But we're already starting to see that people understand that this is the structure of how mortgages are. And once they go through the lensn.com, once or twice, they very quickly realize how powerful that tool is. And most of the time, people aren't going anywhere else after that.
Absolutely. Information is key, and knowing all of this that was never possible before AI and using algorithms. So smart, Jon. I love that. You want to take out the subjectivity of the decision-making process as much as possible, the human emotion out of it, except for the timeline, like you mentioned. Sounds like a great business model. I love it. So now what markets does it focus on? Is it US or is it global? Tell us about that.
Yeah, right now it's just in the US. We do have some international objectives in mind, but for right now, we want to continue serving the US market primarily, refining the tool. There's some other aspects to the loan origination process that we're still trying to fully automate. Our goal is basically A to Z, that someone can go through the upfront shopping experience, which exists right now, all the way to the end loan without interacting with anybody.
Ooh,
Some people have very nuanced situations. So there's going to be times where if they don't fit perfectly in the box, they're going to need help. But overall, the vanilla borrower who is making a W-2 income, has everything stated on their tax returns. We have 2/3 of that process already fully automated, through our own AI and AI tools that are growing equally as fast as us that we're integrating. We think a lot of that approval process is going to be instantly automated. And there's some other blockchain technologies that we have being worked on as well that I think makes some of this process integrate ultimately on the real estate side. So the way we envision it, the way I envision it, is that this is going to be, for the most part, a non-human experience from start to finish. And I'm not just talking about the loan, I'm talking about the entire shopping experience. If you can go on a website like Zillow, find the house that you like, do a walkthrough, there's no real reason why a human has to give you a tour of the home. You can handle that yourself. And then you have a digital financial platform like lensend.com that allows them to do the full shopping experience, get approved. And that's a trusted source because of other blockchain sources. It says they've been fully verified with Lensend. There's no reason why, the same way you go on Amazon and buy a new set of bed sheets in a few clicks, there's no reason you can't do that, in my opinion, in the housing market. And so far, we've seen a lot of conversation and hype around doing something like this, integrating blockchain, integrating AI, and all these different components, but no one's actually built anything. And so I think we're way ahead of the curve on that because we already have the user experience nailed, and we're already well ahead in some of the other back-end stuff that we're hoping to integrate into whatever the future marketplace is, so that people can, a few clicks, buy a home. And I don't think we're that many years away from that.
absolutely. I think that is the future, and you are ahead of the game there, making it seamless and automated as you have with Lensend. I find it a fascinating business model. So very cool. Lensend.com, correct?
Lendzen, correct?
Love
Yes.
it. Fascinating stuff. It almost seems like, being a business person myself, I'm thinking, we could maybe put it together with Zillow or Redfin so everyone could just buy the whole home and use your service all together as one package from start to finish. Really, really
Yeah, look,
cool stuff.
yeah, to connect the dots of some of the things that we've talked about is, the cost of homes is a big issue. It's one of the core things that we've discussed here today. And personally, I think one of the easiest ways, or not the easiest way, but it's certainly one of the biggest impacts that we can make to the cost of housing, is eliminate all the fat, all the third-party expenses that inflate the transaction costs. And I think, again, going back to this settlement with the National Association of Realtors, I think initially that just is a really big bonus for sellers, because now they can negotiate more aggressively the listing contract, and buyers agents need to go get their own compensation. But I think over time, that ultimately compresses that market significantly, and competition will eventually pass that on, in my opinion, to the buyers. I think you're going to see home prices come down to some extent because there's, just like we talked about in the beginning, home builders have so much margin that they're able to get not only aggressive on price, but they're able to incentivize buyers with lending incentives, or at least credits to make the interest rates more attractive. At some point here, I think sellers are going to be able to do that because they're not paying 6% of a $500,000 purchase to two agents. And it's not to take away from the value that many of them do provide in the marketplace, but I think, again, going back to this AI thing, there's so much happening so fast, and anyone who thinks, oh no, not my industry, oh no, no one can replace me, you're not paying attention. And you need to lose that cognitive dissonance, because it's coming for all of us, and especially in the service-based industries, because there's so much there that can be automated, even with the current level of artificial intelligence we have right now. And there's enough tech in place that all you really need, like you're saying, Zillow cooperates with a Lensend, and suddenly you have a marketplace that cuts out a lot of fat. And yes, there's going to be a few players that are going to dominate in that space. They're going to make a lot of money, but they're going to be making a little bit of money on a big volume of deals, the same way Amazon does in the retail marketplace. And I think that's coming for a lot of industries.
Well said. I agree completely. We have been implementing automation in our business as well. And, like I said before, inflation is here to stay. Margins have thinned. And I've had this discussion for years now. We have thinning margins and we need to find ways to recover, reduce costs, reduce these middle fees that we have. There's new fees and higher fees. And so we need to reduce and cut that fat, like you said, and having automation AI is absolutely imperative to help increase those margins again and be able to keep that bottom line up. And so this is much needed and great forward thinking, Jon. Definitely a very, very important part of the real estate process, finding the best rates possible out there objectively and automated. So you're an expat. You're originally from the United States, but now you're in down under in Australia. Tell us about your journey living such a fascinating life.
Well, I grew up in the Northeast Pennsylvania, just outside of Philadelphia. Had a very fun childhood, enjoying the four seasons, but eventually the winters just got to me. And right around the time I had finished college and I had my university degree, I decided to move out to Hawaii, having never been. 15 years later, that was my life. I was living on the North Shore of Oahu. I was surfing amazing waves. I was living this tropical paradise lifestyle. But around 2016, I started looking at more of how I could position myself for the next crisis. Kind of that plan B mentality before everybody was in the plan B mindset. And I started exploring other parts of the world, and I lived in Latin America for a while. And I was one of the first early movers to Puerto Rico for the various tax incentives that they had. And it's been quite a journey. Over that period of time, I collected roughly six permanent residencies, or I was a resident of six countries. That's different than holding a passport, but the first step before you get a passport in a country is you become a permanent resident. So I'm very, very familiar with this journey and what the process is like. And a lot of people are out there, they have YouTube channels about this, and yet they've never actually, done the boots on the ground process. I've been through all of it. It's exciting. It can be daunting, and a lot of times it can just be a big waste of time until you kind of go through and figure out, is this the place I want to be? Not only because of the way the country operates, but just bureaucratically or environmentally, is it the right fit? And sometimes it's hard to tell until you're actually in the process. But one of those countries became Australia. I was able to acquire permanent residency here, which is very, very difficult to do. I had been traveling here a lot from Hawaii because it's somewhat in close proximity. They have in the Sydney area in New South Wales, they have very mild weather. The winters can have moments of cold, but the summers are beautiful and the seasons are opposite. So I was coming here in the dead winter of Hawaii, which is, if there's 2 months out of the year you don't want to be in Hawaii, it's probably January and February. It's very wet. The ocean is very volatile, not the type of stuff you see on surf movies. That tends to happen in November and December and sometimes in March. So January and February, I started coming here. I really fell in love with the place. And now I'm kind of focused on eventually acquiring a passport here. So I spend my time mostly between here and Puerto Rico.
Exciting. This has been an exciting discussion today, from debt to mortgages to real estate and Australia. Thank you so much, Jon. Tell our audience how they can follow you.
Yeah, I'm everywhere with the handle Jon Kutsmeda. My full first name is Jonathan, so Jon is spelled without an H, so it's JonKutsmeda. That's Jon Kutsmeda. That's everywhere. It's Instagram, Twitter. Twitter is probably where I'm most active, on YouTube. You can also check Brent Johnson and I with our Milkshakes Markets Madness podcast using the handle Milkshakes Pod. We have a lot of fun on both YouTube and Twitter with that. So I'm pretty easy to find. I'm active in all of those things. And, it's been a great conversation. I think you asked a lot of well-framed, wonderful questions. I appreciate that. And, throughout this entire conversation, we've covered a lot of things. Is there anything based on what you're doing professionally that, you want to add to some of the topics that we've shared here today?
I think I've already talked too much. I always talk too much because I get so excited about economics and real estate and everything, but I appreciate you asking. And I have to say, you are very eloquent with your discussion, very articulate in explaining your thoughts. And we really appreciate you sharing your valuable insights with us and your expertise in mortgage and real estate. So I want to say thank you, Jon.
Thanks, Rob. I really appreciate it.
Thank you.